Buen día, buenas tardes. Fabián Onetti con presentaciones especiales. Tal cual les adelanté hoy, tenemos a la gente de Aurum, Kevin Gundel, que nos van a hablar de un fondo que, como dije, es un fondo que lo empezó una familia hace más de 23 años y eventualmente lo han abierto al público y aparte está en la plataforma de Pershing por si alguno tiene interés. Sin mucho más, Kevin, why don't you walk us about the story, your philosophy, and your product?
Thanks very much. Pleasure to be on the call. I'm phoning from London, where most of our research and due diligence capabilities are based. And this year, well, actually next year, we celebrate our 25th anniversary as a business. It's a business that I started with colleagues in 1994, and we started managing our own money along with some family and friends, and it didn't take too long until we were attracting more and more institutional clients. And I think that where we now find ourselves is being one of a handful of firms that has survived 25 years investing in the capital markets, but where the unique qualities of being an owner-managed business, where the owners are the same people that manage the portfolios right from the beginning. And these characteristics are more and more important to investors today. And we know this because the sorts of questions that we are asked by our clients really come from experiences that they've had where they've invested capital with firms, but there wasn't that duty of care, that interest, and that alignment that they see with Aurum. What we have developed over the years is a range of investment products. We focus on hedge funds. Now, hedge funds, we are starting to see a lot more positive things written about hedge funds in the newspaper, which makes a little bit of a change, because ever since the crisis and the fiasco with firms that like Madoff and that sort of thing, you got yourself into a situation where investors' perception of hedge funds was very poor. But right now, the institutional participation in hedge funds has never been higher. The interest in what absolute return strategies can now offer is growing, and for good reason. Many of our investors are allocating more to absolute return strategies because they are nervous. They see that we're at a point within the cycle that demands that they look at things to complement their existing portfolios. So when you're at this inflection point in fixed income, which we read about every day in the newspaper, where there is this concern about the incredibly strong rise of the equity markets witnessed this month alone, and the start of the year is very uncorrelated often to what happens for the rest of the year. And you're getting some pressures. You're getting rates going up, you're getting commodity prices going up, and that's going to feed through to corporate earnings and potentially could have an impact on equity prices. So where we've positioned ourselves is a firm that can add value to existing portfolios. And I think that's probably one of the most important factors that investors thinking of allocating to hedge funds, it's a question that they need to ask themselves, and more particularly the managers that they potentially could work with. Hedge funds are a very expensive fee structure. We all know that. We hate paying hedge fund fees because we're a multi-manager, so we put together portfolios of hedge funds. For all intents and purposes, it's a fund of funds. And we negotiate good fees on behalf of our clients, and we invest in usually the lower cost share classes. However, you don't get away from the fact that some of the best managers are sometimes some of the most expensive from a management and performance fee standpoint. But the question to ask is whether the price that an investor is paying is translates into value that they receive. And the point that I was making about adding hedge funds to portfolios at this point in the cycle is that the hedge funds have got to be adding great value. And the way they do that is by providing three things. Firstly, a lower volatility. Secondly, a lower beta. That's a lower correlation. And that's critical because investors own bonds and equities by and large, and some real estate and other assets. So if you're going to be adding a hedge fund to the portfolio, it needs to be able to demonstrate that it is complementing what investors already own. And you can only complement an existing portfolio if you're delivering something different. And that is why low correlation is so important. And finally, to provide a absolute return. And the way we've positioned our products and the risks that we take is that we are aiming to deliver a return of between 4 and 7%. And we pitch it at that level because it is realistic given where interest rates are. Interest rates, for all intents and purposes, are still at 0%. You don't get any interest on your cash in the bank. So it's unrealistic to think that you can generate a return at a huge multiple of interest rates without taking a significant additional risk. And our preference is to keep volatility low, correlation low, and deliver a return which is much higher than one would get on cash, obviously, but is satisfactory when one looks at other yield-producing assets. And we've delivered this. So over the last 20 odd years that we've been managing this fund that we're discussing today, the Aurum ISIS fund, it has delivered a return of almost 6% net to investors over 20 years. And I think the standout characteristic of the fund is its performance during tough times. And Fabian has some documentation that we've given, just a short sort of 2-page synopsis of the fund. And in 2008, the fund lost less than 5% or thereabouts. And during that, over the last 20 years, there have been multiple market cycles, from the Russian crisis, the dot-com crash, the recessions, the financial crisis, the European credit crisis, and at each event that you've experienced in the marketplace, this fund has prevailed, it's preserved capital, and it's demonstrated that consistency of performance. Today, the fund has got about $1 billion under management, and it's our flagship fund. So for the time being, I will maybe pause it there, and Fabian, perhaps you would like to just prompt me for information that you think will be helpful to your listeners.
Thank you, Kevin. And you got one of my questions already answered, which is AUM, which is $1 billion. And I think you spoke at length about the duration of the fund and whatever. Now, let me ask you a question. In percentage points, what strategies do you own? The most, and kind of first, second, third in terms of hedge fund strategies that you're picking up.
Right, that's a good question. We particularly like multi-strategy funds. And multi-strategy funds are essentially funds that are operated by conventionally larger asset managers, where they set up an internal platform. And the reason we like these sorts of strategies is because the risk management and the central investment oversight of these multi-strategy funds can allocate capital very efficiently to the internal strategies that they manage. So a multi-strategy fund will have an equity market neutral component, they'll have a macro component, they might have a quantitative component, they might have an event and special situations component, all of which are trading the markets that we are all very familiar with: currencies, fixed income, equities, and the like. So right now, about 48, just under 50%, 48% of the portfolio is run using multi-strategy funds. And some of the funds in the portfolio that make up those large allocations, there's a group in Chicago called Citadel Kensington, and that's about 12% of the portfolio. You get Millennium International, run out of New York by Izzy Englander, and that's just over 7% of the capital. And a fund run by D.E. Shaw here, again in the US, and that's about 8% of the capital. So you can see some of the larger positions are with some of the most renowned multi-strategy hedge funds, and Aurum has been allocating to these managers for many years, is very close to their operations, very familiar with how they make money and how they manage risk. So that's the first part. Just multi-strategy funds. The next largest allocation is at about 30% is systematic. Now, systematic, it can be viewed as a bit of a mouthful, but that is essentially a quantitative equity market neutral trading style. And I think that's a characteristic of Aurum. We are very trading orientated. We do not have a buy and hold strategy. Buy and hold strategy is best expressed long only and thematically. It's not why you pay a hedge fund to just invest long only in value. We think that the hedge fund's value added is more trading orientated style, and that's what we focus on. And it's also very liquid. And I think the systematic strategies are a very liquid trading strategy, which again characterizes the sorts of biases that Aurum has. I spoke about 2008. We had a lot of redemptions in 2008 because clients needed their capital, and we didn't have any gates or side pockets or anything like that. Once our clients wanted their money, they got it on time, in cash, in full. We never changed our terms, and it's because we gravitate to liquid trading orientated strategies. And systematic at 30% of our portfolio is a core strategy that's added value over a long period of time. Macro, this is, as the name implies, global macroeconomic trends that managers try and identify and take positions based on global macroeconomic views that they have, and that's about 20% of the portfolio. And finally, event-driven at about 9% of the portfolio. That is special situation investing, merger arbitrage, spin-outs, restructurings. Again, it's an uncorrelated strategies when compared to long-short equity and the like. And we like it because it adds something different. Now, those are the four strategies that we have in this fund: multi-strategy, systematic, macro, and event-driven. One of the things that you will really notice is that we don't have any long-biased, long-short equity funds. We also don't have any structured credit. We don't have any distressed or mortgage-backed securities trading. We don't like those strategies because we do not feel that they are additive to what we do. We're not suggesting that investors shouldn't allocate if they've done their work, but in order to deliver what we believe is something different to complement investors' portfolio and demonstrate low volatility and low correlation, we have selected specific strategies that, taken together, deliver those results.
Super. Quick, 20 seconds. Any particular philosophy when you select managers, Kevin?
Well, firstly, it's a culture of risk control. Risk control is a critical cornerstone of how a manager needs to think about their portfolios. And unless a manager has a risk control methodology really as part of their DNA, we don't really have any interest in investing, because we want there to be a direct attachment between the decision maker, the investment thesis, and how that's expressed in the portfolio. But covering all of that needs to be a risk management methodology that they absolutely adhere to. So I think risk management is a cornerstone of the sorts of things that we look for in our managers.
Super. I'll open the lines. Si alguno tiene alguna pregunta o comentario, bienvenido. No? Okay. Kevin, thank you very much. If anybody wants more information, let me know. Like always, we'll connect you directly with the fund for any more inquiries. Thank you, Kevin. Have a great day.
Thanks a lot. Bye.
Thank you. Bye-bye. Thank you.
Goodbye.